everyone, this is Jeff Praissman with Interactive Brokers Podcast. It's my pleasure to welcome back to the IBKR Podcast Studio for Market Chameleon, Will McBride and Dmitry Pargamanik. Hey guys, how are you?
Hey, Jeff. Thanks for having us.
Hey, Jeff. Thanks for having us. It's always a pleasure.
Love having you guys in. And, we just finished up a great webinar talking about credit put spreads, and excited to have you guys in the studio to kind of do a deeper, maybe just a different dive on it. So I'm going to kind of kick it off for you guys. And, for our listeners that may be new to option strategies, could you break down exactly what a credit put spread is? And why is it becoming such a popular strategy among retail traders?
Yeah. So the credit put spread, it's a strategy that involves two legs. You're selling a put on one strike and then buying a put on a strike below in the same expiration. And this allows you to trade with a defined risk. You kind of take an option where you are selling one option, but you want to define your risk. So you're buying another option to stop you out at a certain point. And I think to the next part of the question, why it's becoming popular, is a couple things. One, there's more education and knowledge and videos about using spreads, particularly, either call spread or put spread as a strategy when you trade options. So more people are starting to learn more about it and understand it. And I think it's also become much easier to execute strategies because now you could set up a strategy and get it executed with one order type. So just like with Interactive Brokers, you could enter in a call spread or a put spread.
I don't know if you guys can hear me. You guys all froze.
It's become much easier, and then get it executed all with one order, or enter it in all with one order.
Hey, Will, Dmitry, because you guys all froze on my end. Can you guys hear me?
Yes.
I got you now. You're back. Yep.
Yeah, unfortunately, I think, I know, Andy, did you get what Dimitri's answer? I mean, it's fine if we got the answer. It just froze on my end, where I saw everyone freeze. Okay. Okay, so we should just go on the question 2 then? Okay, perfect. We can always edit this stuff out too, guys, or re-record one line or whatever. When comparing credit put spreads to, other bullish strategies like buying calls or selling naked puts, what specific advantages make these credit spreads stand out in terms of risk management?
Yeah, the difference is that they happen to all be bullish, the ones that you described, buying calls, selling either naked put or credit put spread. But what some of the advantages in this, there's always, some advantages and disadvantages to all of them, but what makes credit put spread stand out is when you buy a call, you're paying for an option, it's net debit, you're buying premium. Some traders prefer to sell premium or sell implied volatility or sell options. And when you go to the other side, to express a bullish viewpoint, you could sell it out of a put or an out of the money put. And there you have risk where if the stock starts to go against you directionally, well, you have, undefined risk all the way down if the stock goes to zero. So you have a lot of risks. The credit put spread, when it comes in, is that you're doing two options, and this allows you to predefine your risk at the outset of the trade, because if you sell one put and you buy another put, then that the most that put spread will be worth is the difference between the strikes. If you're selling $5 put spread, it'll be worth $5, $10 put spread, $10. So knowing how much you're selling it for and ahead of time, the max value allows you to predefine that risk at the start of the trade, at the outset of the trade.
And, during the webinar, which, for our listeners, if you missed it, you can always find recorded copies, on our website at Under Education. But, you mentioned that credit put spreads can be structured, either near the money or out of the money. Could you walk us through how these different approaches impact the risk reward profiles for when a trader, when a trader might choose one over the other?
Yeah. So when we look at options, we have different strikes, and we compare those strikes to where the stock price is. And a put, when we sell a put or a put spread that's further away from the stock, look at the downside strikes, that's an out of the money put spread. And that's where, the stock for that put spread to, have value at the end of expiration, the stock has to decrease by enough, to get that put spread in the money. And that money put spread, on the other hand, is where you're selling the strike right where the stock is, and buying another strike below. But even if that stock falls a little bit, if it starts out at the money, it's going to be in the money. It doesn't have to fall that far away. And the difference is when, if you're selling an out of the money put spread, you're going to get less premium, because the stock needs to fall by, you have that cushion, right? That the stock needs to fall enough for that put spread to be in the money. So you're going to collect less premium, but at the same time, you have that extra cushion that if the stock goes directionally against you, you have the room, because of the strikes. And at the money, you don't have that same cushion, but your potential to get more reward because you're selling at a higher premium.
Right. So really at the money, the bidder, probably the more chance that it might, expire at the full value, but it's going to cost you more. But, out of the money, less chance, but you're going to have less chance of it, either one, lower or higher strike, being exercised or assigned, depending on, which side you're on.
Right.
And, when you're looking, obviously traders like metrics, right? And that's a key part of this is just research and data. So what are the most critical metrics that they, kind of focus on when screening for credit put spread opportunities? And, why are they more important than, say, the other data points?
Yeah, I don't know if there are metrics that are more important than other ones because it depends. Each metric's telling you just something different, so it's different information and how you factor it into your overall assessment of the trade. And we see, one of the ones we did discuss recently is just how far away, how much cushion do you have, in a put spread. Other metrics you could use is how much liquidity is there, are the options that you're looking at, do they have a lot of volume? Are they have open interest? This helps with price discovery, liquidity, and execution of getting in or out of a spread. Valuation models, where's the market price relative to a theoretical value or benchmark, and how far away is it deviated from my benchmark theoretical value? Some other metrics are, probabilities or theoretical probabilities of this finishing in the money or out of the money or profitable or unprofitable. There are many different types of metrics to look at. And again, I don't know I can't say one is more important than the other in the sense that, well, don't worry about these, just look at this, because each metric is just telling you something different. And it's important if you need that information.
Right. And I would think it also just depends on the trader themselves and also, their portfolio and their position to begin with, right? Like there's going to be certain metrics that are, we might be doing the same trade, but or we may have the same, a different portfolio and looking at the same trade. And for me, I might be looking at metric 1, 2, and 3 and saying, okay, judging by what I have, this is probably the most important points, whether I want to do it or not. And then you might be looking at the, same trade and have a, different position and looking at, metrics 5, 6, and 7, being like, no, these are the most important for my position. And, so it's pretty fluid, I would think, as far as where you're at, where you want to go, and, what you're trying to accomplish too.
Yes, exactly. But because of your unique circumstances. And like you said, both sides of the trade, that trade could fit into what they need to do, right? And what they're looking looking for overall in their portfolio.
And, historical win rates seem to be a key component of the screening process as well. How are they calculated? As
Yeah.
far as
So
and also I guess, how, obviously they're based on the past, right? So how predictive are they to,
right.
future success?
Yeah. And it's a good question because what we do is when we look at a strategy or or a trade, and then we start looking at it from the perspective of, how likely is this trade or strategy given the, conditions, success. And we look at it from a historical point because we don't know. Obviously, we don't know what is this option going to be worth a month from now. We don't know. Otherwise, it would be very easy. But what we do is try to get a sense of how likely something happened in the past, not necessarily because that is going to happen again in the future, but is it in the realm of what realm of possibility? So I'll give you kind of an example where, because we're talking about football before this started, and you might ask, well, how, what are the statistics or metrics of a kicker kicking a field goal from 50 yards away? And we could say, well, the last 3 times he tried it, he was successful. Does that mean the next 3 times he's successful? Well, no, that doesn't necessarily mean that, right? That we can't conclude that, well, because he did it 3 times in a row, he's going to do it again 3 times in a row, or that he'll be successful every time forever. And in addition, we can't say the factors will be the same either, because you have like wind, health, and stuff like that. But what it allows us to do is come up with an idea of the realm of, are we, if you ask somebody, well, is he going to be able to hit from 50 yards away? Well, we could look at it historical just to get an idea. Well, how good was it in the past? How did it look in the past to help guide us? It's like a factor, a piece of information to help guide your overall decision making. So it's like a quick reference point, to look at when you're making those decisions.
And, we're coming up on earnings season. Next week we have the big banks, JP Morgan, Bank of America, and so forth coming out on the 14th. So it kind of seems like a timely question to ask, like, how do you recommend, incorporating, these, corporate events like earnings announcements, in this credit put screening process? Are there specific adjustments you make, the criteria or the volatility that, obviously kind of surrounds these events?
Yeah. So that's a good question. Kind of follow with the example we're looking at is that you'd want to look at when you're making a comparison or making an evaluation, or try to find in the past similar situations so you could analyze. So like we said, well, how successful was this kicker from 50 yards away? Well, that's the condition, right? We could say from 30 yards away or 20 yards away. It'll make a big difference, probably where, from 20 yards away, you might be much more successful than as you get further and further away. Well, same thing with options and events where you have earnings, which create more volatility, right? So more volatility says that the stock could move more violently or reach strikes. The probability of reaching, further away strikes increases than when you happen a period where we know the earnings aren't going to get reported. And so in that situation, when we're looking at something like a credit put spread, and we're trying to evaluate it and see, are we getting a reasonable premium given the conditions, right? Given the conditions that we're expecting. And for that, we would have to look back historically for periods that covered a condition, similar conditions where there was an earnings or a corporate event that we're talking about to give it a more fair and, closer evaluation.
And, sometimes I think one thing traders kind of struggle with, especially ones new to options, like you don't need to hold an option to expiration, right? Like part of it too is buying and selling or closing out a position. And I think a lot of
Yeah.
times people struggle with, determining the optimal time to sort of exit a position, in this case, a credit put spread. Do you have any other exit strategies you found more effective, based on historical analysis?
Well, I think, entering and exiting positions, there's so many factors involved in, like we were just discussing, and you mentioned that it will be unique to the person and to their position. So sometimes you may have, let's say, just the credits put spread that, maybe you sold it for one reason and something changed. The conditions changed, the reason changed, and you might want to exit just for that reason, whether it's profitable or unprofitable, right? Or, what you thought it was worth versus what you thought, at the time you traded, and what do you think it's worth now, or how it fits into your position overall. Because sometimes, even when you have a, contract or position on, it serves your overall portfolio and it reduces the risk, and it might be necessary. You might be actually profiting from it, but you still need that option because it balances out your risk, right? So if it does that, you don't want to, by exiting it, you might just be increasing your risk that you don't want to do, right? So there are lots of different scenarios and factors when it comes to managing your overall risk portfolio of why exiting or entering, or maybe you're exiting because you found a better opportunity, and by exiting it, you're freeing up, funds to go to that, for that next opportunity. So it's very dynamic and unique. And that's part of just managing risk and trading.
Got it. And then kind of to pivot a little bit, a lot of times technical analysis and, option strategies kind of go hand in hand for at least certain traders. Are there any specific, technical indicators that you found, work particularly well when screening for credit put spreads?
Yeah, so the technical analysis has to do more with analyzing the stock behavior, with how the stock's moving. You're looking at the stock behavior with different technical indicators just to get a sense of, we're talking about volatility, but even directional, is it, doing this or that? And you're looking at it really from a historical standpoint, just to give you an idea of that stock's behavior, how, what it's been doing, and does it fit into your, outlook for that stock. So it's just another metric or assistance, but really has to do with analyzing the stock itself.
And, obviously volatility plays such a crucial role in option pricing. And, how does your screening approach adapt to different market volatility regimes? Are there adjustments you make, during extremely high or low volatility? And obviously, as you mentioned before, these credit spreads, these credit put spreads, and they involve buying one option, selling another option. So it's a little bit different than a single option where they are offsetting a little bit, but obviously different strikes have different volatility. So kind of, even with the offset, they can kind of diverge or kind of converge depending on the, the period of time, I would assume.
Yeah. That's a good question too, because when we look at selling an option, buying an option, you do, besides when we're talking about stopping out a directional risk, you're also offsetting some of your vega risk because you're selling implied volatility and then you're hedging it by buying implied volatility. So if the implied volatilities go down, while you're short one, you're long the other, they're offsetting. If they go up, you're long one, short one, they're kind of offsetting. So that's one of the advantages of actually doing a spread, because if you just buy one option, you have full exposure of long vega. If you sell one option, you have full exposure short vega. And that's one of the benefits of, buying and selling, is that you're reducing that risk, hedging some of it off. And the relationship between the two also matter, right? Because there's some relationship between options, where one is not going to just go flying through the roof and the other one going straight to zero. So there is a relationship that we could test historically just to see where that relationship is today, versus historical benchmarks. As far as overall volatility, then the options will move around, with overall volatility. You're probably going to, you're going to get more premium, at the monies, usually, as the implied volatility goes up. But the benefit though, is that, you can hedge off or offset some of that bigger risk, the implied volatility risk.
Got it. Well, Dmitry, this has been great. Are there any final thoughts you'd like to leave for our listeners?
Yeah, I think that, when you're looking at trading, and especially some people who have started trading and are looking at, buying or selling a call or put, I think the very next stage is just to move on to a two-legged spread, right? The call spread or put spread. And just understanding that, the benefits of call spread or a put spread, in this case, a put spread, how you could use it, when you could use it, how to evaluate it, becomes very important. And it's a lot of times it helps you achieve what you're trying to achieve with that defined risk.
Oh, great. And once again, for our listeners, Dmitry and Will from Market Chameleon, you can find a lot of great webinars and past podcasts on our site. And also, check them out. They have a morning YouTube show, I believe at 9 o'clock, guys, or 9:30 Eastern time.
9 o'clock.
9 o'clock, great. So check out their YouTube channel as well. And for now, that's all. Thanks, guys. Really appreciate it.
Thanks, Jeff. Always a pleasure. Great
Thanks,
job,
Jeff.
D.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Options involve risk and are not suitable for all investors. For information on the uses and risks of options, you can obtain a copy of the Options Clearing Corporation Risk Disclosure document titled Characteristics and Risks of Standardized Options by going to the following link: ibkr.com/OCC. Multiple leg strategies, including spreads, will incur multiple transaction costs.